Today, we're going to be talking about how professionals really trade and why they choose this method over the more traditional retail methods that you are probably familiar with. So I've prepared a fairly large presentation today because I really wanted to go into this in depth. So I really hope that you enjoy. So without further ado, most retail traders are set up to fail, right? This is not because the markets are secretly rigged, but it's because the way that the ecosystem has been built over the years teaches traders systematically to think and act in the wrong ways, and sometimes the complete polar opposite way to how professionals approach things. Now, I just want to make it clear here, I'm not talking about some invisible boogeyman who's going to hunt your stop and take you out, or some other wacky conspiracy theory that's all over the internet at all times, because it's actually in a way much simpler, but it's much deeper than you might think. So I'm talking about everything, right? From the products that you're offered to the way that you're taught to trade. Often it is built in a way to make you trade more often rather than to trade better. And this is going to become important as we go through this presentation. So if you have been in this system for, at least 3 months, probably at least 6 months, you've tried various things, you've probably felt one or multiple of these before. The first one is you've traded for months or years, but you feel like you are going around and around and around in circles. Or you backtest the system and it looks like it works great. You then move it to live, and either straight away or eventually the strategy falls apart and you're back to square one. You feel like you've wasted all of that time. Sure, you've probably been there on that one. Next one is you've tried strategy after strategy, but you've got no real measurable results to show for it. And then finally, the big one that I think every trader hates is the feeling of sitting there having putting in tons of work and going, I don't even know if this is possible. Is anybody out there making money from trading? Now, this is a feeling that I know extremely well. Okay, extremely well. Now, if you've never seen any of my videos before, I've been trading for about 8 years. During that time, I've tried basically all categories of retail strategies that you can imagine. Tens, if not hundreds, of scalping strategies, day trading methods, grid trading systems, algorithmic systems, event strategies, pure fundamental systems, sentiment systems, a million things in between. You name it, I've probably tried it, unless they're kind of giving it some fancy, unique name to make it sound original. But in general, trust me, I've tried it. And for the last 4 years, I've run this channel. So hi, this is me. And during that time, I've helped thousands of traders. But most importantly, I've been able to see patterns on why 90% of retail traders lose money. But also, I've had the privilege of seeing what separates the best traders and what makes them different and what puts them in a good place. I've also had the good fortune of meeting some people who are actual professionals and understanding how they look at the markets. And it was so wildly different from what I thought that my mind was blown. And to be honest, it kind of shocked me, but I'm getting ahead of myself. We'll come back to this. So just to be clear, what are we answering today? Two questions: how professionals trade and why they trade this way instead of other ways. Pretty simple. And quickly, guys, as always, nothing in this video is going to be financial advice. The purposes of this video is just to educate and hopefully share some ideas that you have not heard before. So anyway, without further ado, let's get on with the rest. So to understand how professionals trade, we first need to understand the disadvantage of retail traders that I was just talking about, right? And so when I say that the structure of the industry is set up in a way that guarantees most traders lose, that is something that I want to show to you visually. And by the way, this is something that every single professional knows. This is one of the first things that is taught, or is at least assumed, when you get into a professional atmosphere, and you'll see why. So the first thing that's really important to go over is the financial incentives for retail brokers. Now, by retail brokers, I'm typically talking about CFD brokers. Some of these principles will apply to other types, but other brokers, some types of brokers are way better than others. But this is not a video about picking the best broker or this or that. It's nothing to do with that. But it's really important to understand this, because if you don't understand it, you won't understand how retail traders are often manipulated, and the information that you are learning now, or from anybody, where it originally started. It's almost like a history lesson in a way. So the statistic that you may have heard is 90% of retail traders lose 90% of their money in 90 days. So up here we have the easiest money. This is the easiest money for a retail broker to make money off of you. So that's going to be volume traded. So this is going to be like the spreads, the commissions, when you just transact with the broker. In terms of medium level of difficulty relative to the others, we have trading the opposite of losers. So I'll explain each of these more in a minute. And then the hardest money for them is copying the winners. So let's break each one of those down a little bit more, because that may or may not make sense. So volume traded, as I said, every single click, every time you buy and you sell, and the more leverage you use, it's guaranteed commission, it's guaranteed spread or something. And so that's guaranteed profit. But the market goes up, down, up, down, up, down, up, down. Great, easy money for them. They don't have to do anything. They've built the platform. They basically just collect the money. I've also realized my head is in the way of this, so let me just change that quickly. Now I'm tiny in the corner. Anyway, so next one down, we have most retail traders predictably lose. So again, when you look at this statistic, 90% of retail traders lose 90% of their money in 90 days. Keep in mind that statistic will only get worse the longer the time horizon. So if you say how many retail traders lose their money within 180 days or a year or 2 years or 3 years, that statistic is only going to go up. It's going to be more and more people losing money. Part of that is psychological, but also it's because of the way that retail are taught to trade. It can't survive. And we'll talk more about that as the video goes on. And so the whole idea from a retail broker's perspective is if they just take the other side of most retail traders that work through them, then that's going to be statistically profitable, because if most people are losing and they just do the opposite of what the losers are doing, then that's going to be profitable for them. But the reason it's not easy money is because it adds complexity to them and it carries exposure risk, meaning they are engaged more heavily in the market. They need more sophisticated hedging protocols and various things that I won't go into because I'm sure it will bore you. And then finally, we have copying winners as harder than taking the opposite of losers. Why is that harder? Well, because number one, very few traders win consistently. And as I said, as you stretch that time horizon out even more, it becomes even less, even a smaller amount. Or you may have someone that's winning for 6 months and then becomes a losing trader. So again, it creates risk for the broker. But not just that. The way brokers work is they're constantly needing to balance wins and losses across thousands of traders and also hedge their own risk as a brokerage firm so that they don't lose all their money. They're in business after all. That's fair enough. And when they copy the few people who actually win, it can break that balance a little bit more. So what that means is that suddenly the broker's overall positions may point or be weighted slightly more to one side, like they might be overly long on the US dollar across various currency pairs, for example. And so that opens up more complexity and more risk because they are exposing themselves in a certain way. And as I said, because very few traders win or consistently, it becomes a little bit of a scenario where they're trying to understand, okay, well, who is winning? How do I make sure that they're not, just winning now and they're going to fail in the future? Lots of complexity that it adds. Now, one thing that is really important to note here is that brokers don't care, contrary to popular belief, whether you win or you lose. The benefit of having the financial services industry as being so regulated is the whole point of regulation is to make things fair. And so it would be unfair if brokers were literally just trying to make you lose. That has been the case with some examples in the past and with some unregulated offshore brokers. But this is a good thing, because it means that for us, it means that they don't care whether you win or you lose. That being said, in an ideal world for them, whether they say it or not, it's easier for them for you to lose. That's the bottom line. So just remember all of this because it will come up later. So the second thing is the market incentives. So what markets do retail brokers want you to actually trade? And by the way, when I'm talking about retail brokers here, I'm talking mainly about CFD brokers, meaning contracts for difference brokers. So the types of brokers you're going to get for most FX trading, a lot of some commodities trading, indices, certain stocks, if you're trading stock CFDs. These things are typically going to be CFD brokers. Some of these principles apply to other types, but less so to some of the more sophisticated ones. This is not going to be a video of me comparing what's a good broker and a bad broker and all these sorts of things, but I can make one if you're interested. Let me know in the comments. But first of all, we need to understand this, otherwise none of that conversation means anything anyway. So the ideal market that a broker wants you to trade. So in an ideal world, brokers want you to trade a low volatility, meaning a asset that doesn't move much, and they want it to be highly liquid as well. So an example would be a major FX pair such as Euro USD or GBP USD or whatever. And so have you ever wondered why brokers offer much higher leverage for assets like FX compared to stocks? There is a very, very good reason for this, because the more liquid an asset is, meaning the more money is flowing through that asset, it means that there are less big moves. The reason that there are less big moves is because when it's more liquid and there's more money in the market, there's more people willing to buy and sell at every single level. This means that more liquid markets, typically, not always, it's harder and takes more for them to have a really big directional move. The more money is in the market, the less volatility typically it has. You'll see a classic example of this if you look at something like Bitcoin back in the early days when it was very illiquid. It was moving huge gains, tens of thousands of percent. But now that more money has flown into it, whilst it's still having crazy, really nice gains, for the most part, it's not as big as it was in the past, at least not over the same short time horizon that it did. And there's a reason for that. It's down to liquidity. So I'll say it again, more liquid the asset. That means less big moves. Less big moves is important because it means that the broker can hedge, meaning they can take the opposite of your position or they can protect themselves in another way, very, very close, if not at the exact same price that they became exposed at. So if you buy and they sell at the exact same point, that's reduced exposure for them. So if there's less risk for them, they can offer you more leverage as a result. Now, the flip side is also true. So markets, brokers least want you to trade. So high volatility, less liquid assets. Again, they can't force you to not trade these. So a lot of them do offer it, but just the way that they hedge and control their risk is changed. So in these scenarios, kind of opposite to the last one, you have hard to hedge, big jumps, wide spreads. Sometimes the market may gap and they may not be able to actually, get filled and hedge themselves properly. This all creates risk for the broker. And as such, you will see that the amount of leverage they offer you with different assets will fluctuate a lot. Now, this is all going to become important as well, because if you think about it, when it comes down to how certain low volatility assets are pitched to retail traders, especially with things like FX, brokers are always talking to you in pips. Pips, 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 pips. It's so much more attractive to say that Euro USD dropped 50 pips today than to say it dropped by 0.43%, And so whilst pips are still good, it doesn't mean pips are bad. It just means that they are using language that will steer your psychology towards a certain way of thinking. And it will become clear why this is important in a minute. So what's the result of all of this? Well, it means that the brokers are incentivized, right, to make you do a few things. Use low volatility, highly liquid assets because it's less risky for them. Use high leverage because it's more spread and more commission for them. And trade frequently, which means more volume, which means faster commission for them. Now, an important note, as I've already said, nowadays brokers don't care if you win or lose, but if you lose, it is less complicated for them. So there's kind of like an unwritten, informal incentive on the back burner. They just can't formally chase that for you. So now I'm in the top left with my tiny little head. So what does this mean? Well, it means that over time, trading education began to glorify methods that benefited brokers, not traders. Think of the amount that scalping and day trading has become a common thing in terms of the public eye. Like when you think of most retail traders these days, it's all like, 10 screens, retail trading, in and out of positions all day, pressing buttons. Like that's the perception, whether we like it or not, that a lot of people have of what professional trading really is. The next thing is that educators start educating based off bad initial information. Now, as a follow-on from that, educators need to learn from somewhere, and so they learn from other educators. And what you end up getting is like this kind of giant game of Chinese whispers, where each time they say something, it gets, they add to it, and then it changes. And then by the time you get to, the end, it's like, wow, I can't even tell what's good information, what's bad information anymore. And just as a kind of caveat to that as well, some educators have good intentions, but they are misinformed. And others have the same incentives as brokers if they are partnered with one. So you're going to find a lot of the times, a lot of these people with signals groups and stuff where it's free to get in, but you've got to deposit money with the broker. Not only is that really against so many regulations and often illegal in many parts of the world, but that also directly means that they have the same incentives as a broker, and therefore they're going to incentivize you to trade in a way that benefits them and not you. That's a huge thing because it means that everything that comes out of their mouth is biased. Would you listen to a scientist who kind of listened to the research, that would help, a doctor, for example, that kind of listened to the research, but kind of had their own beliefs based on what they saw in a few YouTube videos, and so just steered you towards medications that made them more money? No, you'd want someone that's objective and based in facts and research. That is a no-brainer. And yet, when it comes to people's own focus in their own trading, they neglect that line of thinking. And for the most part, it's not actually their fault because the retail industry has been designed to literally keep this information either from you or just sell you the dream. That's the big thing. And so, as I kind of touched on, today it's almost impossible to separate good information from bad information. And you might be thinking, yeah, great, but I've got tools like ChatGPT, and that's great, but they don't fix this because so much of the trading education that it's trained off of, because AI has to learn off something, is based off decades of bad information. It doesn't mean good pieces of information aren't in there. It just means that if you think about it, if you were training an AI model, and you needed to make it learn everything about trading, you'd probably just stuff everything from the internet you could find into trading, into it, and then let it learn, let it do its thing, and then it would basically spit out answers and work. The problem is that if you're not taking the effort to detect, okay, is this good information, is this bad information up front, then it's just assuming that all education is equal unless you prompt it very, very specifically. And this is the case because obviously the people programming ChatGPT and these other AI models, they're not going to be experts in every field that they are pumping information into it to. And so what they would probably do is they'll shove loads of information from each industry and let the AI learn and then just give it principles for how it can learn. That's the real thing. And this is why it's so important. And I've made this mistake of relying on tools like ChatGPT and all these other things when in fact the quality of your prompt is so important. And if you don't have the education to begin with, then the prompts that you put in are only going to feed your own existing biases, which are based off the bad initial information that you have been fed and that the industry basically feeds on. Hopefully that makes sense. And so for these reasons, professionals just don't fall for this. They just don't. So Mark Minervini, he is a 2 times US investing champion who made 334% roughly in a year. And he said, most traders never make it because they study randomness and call it research. Similarly, we have Paul Tudor Jones. He is one of the most successful traders in history. And he said, 90% of the information out there is useless noise. These guys are trying to tell you the same thing in different ways. So professionals aren't playing the same game, which means, and the natural question of this video is, so what the hell are they doing? Fair question. So to answer that, let's compare 5 of the most common trading strategies. By that, I mean like the general categories, because obviously we can't compare every single one, against 5 professional criteria to judge them fairly and see which one wins. And so the first one is going to be survivability, edge, control, friction, conviction. So let's start with survivability. So this is just a word for how well a strategy adapts to changing conditions. For example, we could have a range trading system that worked really well when the market was going sideways, let's just say in 2023, but it collapsed, it failed, it fell apart as soon as the range broke and it became a strong directional market. And so that is an example of poor survivorship. You're going to see later on that a lot of pure technical systems have this fault built into them. Not in every single scenario, but we'll get onto that in a minute. The next category is going to be edge. So this is just a way of saying the repeatable advantage that lets a trader consistently turn risk into reward. An example of a fragile edge would be a setup that looks strong in one backtest or market phase, but collapsed when conditions changed, or you backtested something, looks really good, and then you apply to live markets and it failed. That's fragile because it's not based on anything really that tangible. You've just put a load of numbers in a spreadsheet and think that you're Batman. That's not really how the best do it. Anyway, durable edge. So this is going to be something where the logic still makes sense even when the market shifts because it's grounded in drivers that persist over time. More on this later. So the next thing is control. So how much control a trader has over their routine, including things like chart time, fixed work hours, attachment to time zones, like if they have to trade Asia, for example, or whatever. But control is also about mental control. So if you have a really psychologically stressful system, that's going to be a low control system because you're more likely to do things that you know you shouldn't do because you're staring at the screens all day and it's really emotional and you're going to basically lose control more than likely. Next category is going to be costs. So how much of your edge is eroded by costs, spreads, commissions, swaps, other things, other types of charges that there are. And this is all relative to the amount of leverage needed to make the volatility meaningful. What does that mean? Well, if we have a low volatility asset like Euro USD, for example, in order for that 0.5%, let's just say that's 50 pips, to mean something significant, you're probably going to have to use leverage, meaning each pip is worth more. Now, the more leverage you use, the more cost you have. And so this means that your costs essentially go up the more leverage you use. And if you are trading in a certain kind of way, which we'll get onto in a minute, this is going to become a massive issue. And most traders don't factor this in well enough. Again, more on this in a minute. So I quite liked this picture. This is a classic example of thinking you have conviction when really you don't, because you're jumping off a cliff thinking you're Superman and you end up being just a regular person. So how confident are you in each trade when you take it? This will have knock-on effects to how well you can execute. For example, holding trades, adding to winners, cutting losers. If you have low confidence in your system, or your confidence is based on, a very small backtest or a set of conditions where you're just drawing stuff on a chart and hoping that things are going to shift or that the market conditions are going to persist, that's an example of low conviction. And the flip side would be if you have a lot of confidence for good reasons behind your positions or a set of positions, that's going to be something that we will class as high conviction. So The ideal characteristics that we're obviously looking for are going to be high survivability, meaning it survives throughout multiple market conditions. Edge, a high edge, obviously. Low edge wouldn't really make any sense. Control, high control, ideally. Low costs and high conviction. So let's see now how the most common trading methods stack up. So we're going to go through these one by one and see how they stack up in each of these categories. And I just want to stipulate before we get into this that this is not about me proving one strategy is good and another is bad. It's not binary. This is about understanding how professionals pick their methods to get the best return on the time that they invest into their trading. It's as simple as that. And so to begin with, we're going to be looking at scalping. Now, the definition of scalping we're going to use for this video is any system that trades ultra short-term price movements, dozens of quick entries and exits per day, aiming to capture very small gains from intraday moves. So one thing that I want to make sure that I'm clear on here is I'm deliberately leaving out some other forms of scalping from this, things like volatility scalping. But even then, a lot of the same principles will apply. And I'll explain my logic in a second. But scalping, the way we're talking about it here, in simple English, is if you're trying to make money from directional movements of price on a very, very short time horizon where you're in and out multiple times per day, that is what I'm considering as scalping. I just made myself a little bit bigger just because I was probably tiny and you couldn't see me, which may be a positive, I don't know. So scalping looks like the ultimate trading fantasy, right? Constant action, fast profits, total control, and it is sold to you as a way to essentially tap up the markets for money every single day, extract profit every day. You make your money. It's like a day job, in, out, shake it all about, job done. Sounds amazing. And that sounds great. When you pitch it like that, it's very easy for a beginner or somebody who likes the rush of trading, which is typical with beginners, to be like, oh, this sounds great. This sounds awesome. But the reality, unfortunately, is very different. And let's see how it stacks up against our criteria. So I had to just shrink my face back down there, otherwise it would cover the screen. But the first category is survivability, right? So survivability, we have to rank this as very low. And the reason is because it has been proven, not my opinion, it has been proven that the shorter the time horizon you go on, the more market noise there is. I will leave multiple academic and research sources in the description box below, but I didn't want to make this video bloated with loads of kind of technical sounding stuff, but you're more than welcome to check that out. So more noise means it's harder to find repeatable patterns. Plus, when you do find a pattern, right, market conditions change faster than most people think, especially on these time horizons. And whilst you're trying to adapt whilst you're losing, because how else would you know that your pattern or your whatever has stopped working, you start losing more often. Any edge that you did have usually then gets eroded to next to nothing. Professionals will avoid methods that break the moment conditions change, not because they're scared of risk, but because their job is to survive regime shifts and therefore not lose client money. Think about it if you were somebody managing someone else's money. Let's say someone had 10 million and they gave it to you to trade. If you're liable for that money, if you have any sort of respect and ethical code, you are going to be extremely diligent about what you do. You're only going to deploy the money where there is a clear benefit that you see. However, most retail traders are sold a dream that scalping is very survivable and it can survive lots of conditions, and all you have to do is turn up, press buttons, get better at patterns, and that's it. That's not what a professional will do, but we'll have more on this as we go. So the next category is going to be the edge itself. So again, unfortunately, I have to rank this as very low. So empirical studies show that short horizon retail strategies tend to produce negative expectancy even before costs get involved. So before we even get into the spreads, the slippage, the commissions, all that sort of stuff, most people are unprofitable with scalping just out the gate. So even when the maths looks good on paper, execution friction and adaptive algos raise the edge before you can capture it. So you're usually overexposed to changing market conditions and highly leveraged. We'll talk about this more in costs. The long and short of this is that the actual edge to be exploited is much lower with scalping. That is just the case. Doesn't mean it's not possible. No, of course, some people make scalping work. But the whole idea of this is, for me, for professionals, they want to stack the deck in their favor. They want to play games where they have the biggest advantage, not try to be the 0.01% that can break through and make it work. Next category, we've got control. So control, we've just got low here. So scalping will often feel like you're in control because you're constantly active. But the reality is that often you're being pulled around left to right by micro volatility, and you're panicking every single time the market goes slightly against you or goes with you. You start feeling happy and all sorts of stuff. And so what this means is psychologically, this is without doubt the hardest way to trade because all of your emotions are heightened. You're staring at the charts all the time. Obviously, you're going to be naturally very on edge and wanting things to work. But that also means that you're going to be very attached to the outcome. Combine that with the fact that it's a low edge and it's low survivability, it is the recipe for mental torture. Take it from me, I traded the 1 minute chart only for probably 6 months, maybe a year, I don't know, it was a long time ago. And yeah, it was really bad for me. I ended up giving myself a vestibular, like inner ear balance condition because I was so stressed the whole time. It was horrible. Anyway, I can make a video about that if you guys are interested. So long story short, this increases the amount of mistakes that you're likely to make, which already erodes the tiny existing edge that there is, which basically means you need to be a machine, which, how ironic, the thing that dominates these timeframes is machines, algorithms, adaptive algorithms that have huge advantages over you and me. Next one is costs. So costs here, very high. So when I say high, cost is always relative to the leverage that we're using. So it's relative to the account size specifically, but the costs are higher with leverage. So scalping time horizons means trying to make money from low volatility. In other words, you're trying to make money from tiny price movements. Low volatility, meaning not much movement, equals more leverage needed to make that movement worth your while. More leverage means higher costs compounding faster. You've probably heard of compound interest. Traders always tend to mentally masturbate over compound interest, but you must remember that that same effect happens in reverse. It works against you as well. So most traders completely forget that. And so spreads also become more significant. So the gap between where the actual market is and where the broker gets you in. And this also compounds against you and against your profit. So the result is that you could say, oh, look, I'm scalping, but I'm using a 1 to 2 risk reward to get over this fact. But after costs, all costs considered, you could actually only be getting a 1-to-1 risk reward or maybe even less. This combined with the other factors is why scalping consistently is very, very hard. Again, I want to make this clear, and this counts for all the methods we're going to talk about today. This doesn't mean that it is impossible. Doesn't mean that, but we're comparing to see where we can stack the deck in our favor, and where professionals stack the deck in their favor as much as humanly possible. So finally, we have conviction. Unfortunately, conviction we have to put as very low as well, because scalping demands conviction in an environment that offers none. The tiniest change in flow can flip your signals, so confidence never compounds, it basically resets every single trade. For those of you that have scalped in the past, you will know this feeling. If you are still finding the idea of scalping really interesting, do what you got to do. Go through that process, but I'm just saying from experience and from seeing so many other people go through it, that scalping is at the very least not where people tend to finish their careers. That's just a fact. So in summary, you're basing trades off patterns within a time horizon proven to have more noise. In other words, less patterns. That changes more unpredictably, whilst the costs mean you're already losing significantly worse than pure randomness or with a system with better costs. That combined with the fact that it's very psychologically challenging to execute on, this has to rank as the worst strategy in our list so far. Now, I know it's the first one, but it's still the worst so far. And again, I want to emphasize, this is not impossible. It's just choosing to fight in the most difficult arena with players who have very large advantages over you, specifically algorithmic advantages over you. You might think, oh, well, they're just using algorithms like I could maybe use. No. They are using algorithms with speed advantages over you, adaptive algorithms. These are not your average everyday, like I have an RSI algorithm. It's a completely different game. So the next category is retail day trading. And of course, guys, within each one of these categories, we've obviously got lots of strategies within it. And just to make a video like this, I had to generalize certain strategies into categories. Otherwise, I'd be here forever comparing 1,000 strategies against each other. So the definition for this video is any approach where positions are opened up and closed within 1 or 2 days, typically using the same intraday setup across similar assets each session. So these are going to be the type of people who go, I only trade 3 currency pairs and I day trade them every single day. Or, oh, I only trade this, this, and this, and I day trade them. Or I only trade this and I day trade it. Basically, people who typically have fixed assets that they're looking at, and their focus is more so on the pattern and getting in and out within a day or two rather than the asset selection process. So in this context, the reason I've called it retail day trading is because I'm talking about patterns that are mechanically used every day, which is very different from how a professional approaches short-term opportunities. We'll come on to this later. Professionals do allow for day trading, but it's in specific conditions, which we will come on to as we go on. So first thing is survivability, low. So a little better than scalping. But day traders are often still victims to market environment changes, and they have no idea how to predict it or read it correctly. Often you'll see day traders looking at Forex Factory or MyFX book economic calendars and going, oh, we've got NFP today, therefore, I'm going to stop trading. That's probably the best scenario, or they're going to be trying to trade the numbers or whatever. Professionals do allow for day trading, but only in specific conditions. And it's never like I trade this one very specific asset as a day trader. It's about predicting volatility in an asset and allocating a portion of the capital to that asset to capitalize on it, assuming that other conditions are met. So assuming that the overall risk of all the positions is at a point that aligns with the market. But I'm getting ahead of myself. We'll come on to that in more detail in a minute. Don't worry. So next one is edge. So retail day trading, I have to put as low, right? Because usually it depends on repeating intraday setups rather than understanding when those setups have the best edge and learning how to identify that environment. So without linking trade to volatility cycles, broader contexts, and actual drivers of the market, then the average reward per trade will get swallowed by randomness. Again, it's not impossible. It's definitely more possible than scalping. However, it is still tough. It's really, really tough. And the edge is not as large as with other methods. Let's move on to control. So we'll put this down as a moderate because day trading, like it feels disciplined. You can learn some great habits, I think, from day trading, just like in terms of general habits, because it's same hours normally, same plan, but the market still is deciding where that opportunity exists. Just because you say that you're only trading between 1 and 3 p.m. doesn't mean that the market has to present an opportunity there. Now, that discipline, the reason I've ranked this as moderate is because that discipline's still good. If you're still saying, look, if nothing shows up between 1 and 3 p.m., my trading hours, then I'm going to not trade for that day. That's still a really good start in terms of a psychological habit. And so I have to rank that as a moderate. So routine gives the illusion of control, but true control is selective participation, which is knowing when to sit out. So most retail traders never build that filter, or they build it based on lagging information. That's the key word there. So they stay busy instead of effective. Most trading approaches in general, you will find, is based on lagging information. You will see a lot of the time that people will try and argue that price, watching price charts is less lagging than indicators. But for the most part, that's not really true. And it's not true in the way that they mean it exactly. For the most part, if you are basing 100% of the decisions on just price, you are at a serious disadvantage. Simple as that. So next one is cost. So we have moderate to high. So even if spreads look small, multiple trades per day will quietly compound. Nowhere near as much as scalping. And obviously it depends on how much of a day trader are you. Are you going for 10 pips? Are you going for 50 pips? These questions will make a difference on cost, which is why I put it as moderate to high. Structured really, really well, it can easily be a moderate cost and not too devastating, but it's still going to be a lot higher than some of the other methods that we're talking about today. So slippage, missed fills, commission churn eat into any edge that there might be. Again, not necessarily destroys it, but it will eat into it, leaving most traders working hard just to get to break even. And maybe you've experienced this yourself. You tried various things, you keep doing stuff, and you always end up at break even, maybe slightly above, maybe slightly below. So depending on the trade frequency and the asset, costs can range from manageable to punishing, but they always compound faster than you expect. Self-explanatory. So the final one is conviction. I have to give this a low because without understanding why a move should happen beyond just drawing something on a chart that you learned from a YouTube video, your confidence will be dependent on each trade. If you have a winner, your confidence rises. If you have a loser, your confidence falls. That is not a professional way to approach trading. That is basically a slightly more sophisticated version of hoping and praying, which obviously isn't going to be the best, the best approach. So without a framework that explains why a move happens, conviction dies after every single loss. Super important. So to summarize, Retail day trading feels productive and structured, but it's usually structure pointed in the wrong direction. It rewards motion, in other words, activity, not insight. Trading every day instead of trading when the odds align creates a slow bleed through cost and inconsistency. And you'll see a common theme through this and scalping is the idea that most day traders don't have an idea of when those odds do align. Like they're basing it off of either feeling or a very limited backtest, or just assuming that because something's happened, it's got to continue in the same way. Now, it doesn't mean that it's not possible. It just means that it's not the most effective way. There is a reason why, as we will see, professionals take a different approach. But let's move on to the next category, which is retail swing trading. Now, for the purposes of this video, this I'm going to define as any primarily technical system holding positions for roughly 3 days, give or take, to several weeks. So this is usually directional, so momentum or trend following type systems. They will have varying levels of complexity. As with all these categories, you'll have different variations of each. But we're going to keep it general here so that we can compare pretty fairly, as we've done previously. So the first one, as normal, survivability. So I'm going to put this as moderate. And there's a key reason for this, because swing trading traditionally holds up better than short-term systems because it avoids more noise and randomness. So all other things equal, right? If you just compare, for example, scalping to retail swing trading, just in terms of survivability, because there's less noise, it means that you are able, at least potentially able, to see things that may actually have weight, meaning you see something in the market and you're like, oh, this could lead to this, X could lead to Y. Whereas if you see that same thing in scalping, that's much less likely to be a reliable thing, and it's much more likely to change. Whereas because we are stretching out to broader time horizons, those patterns are more likely to mean something. It doesn't mean they always will, but they are more likely to do that, which means that your ability to learn and improve as a trader goes up. Your ability to adapt goes up, which is why survivability is better than it was with scalping and with day trading. So again, just reinstating that point there, longer holding periods filter out noise and make true market shifts easier to spot, allowing better potential adaptation when trends or volatility profiles change. Next one is edge. So edge, I'm going to put as moderate as well, because there is an edge in capturing medium-term moves with proven market characteristics such as drift. You'll see drift spoken a lot about in research and academic studies with things like stock markets, for example, like post-earnings drift, various other forms of drift in certain asset classes. But because most retail swing systems rely purely on chart structure, the edge can quickly disappear when those patterns no longer align with the underlying drivers of price. So this isn't always the case because you have reflexivity. So price itself can sometimes move price and keep things detached from, for example, fundamentals for a while. And that's okay. And again, this is why the edge is written as moderate, because that detachment is what allows a lot of those things to work. Long story short, if none of that was making sense to you, swing trading in a retail capacity has the best edge potential that we have seen so far, mainly due to the lack of noise and certain proven characteristics of markets that they can capitalize on. Obviously, each market has different characteristics, but they are more definable and findable. So next one is control. So control, we've got to put this as a high. Swing traders have more time freedom, obviously, because decisions are planned. They're rather than reactive. They are kind of still reactive, but people have time to think about them, and the analysis can be done calmly. If you're trading off the 4-hour or the daily, for example, you're not worried about every tiny little tick because prices are moving too slowly for it to matter within the context of what you're looking for. Simple as that. And so still, that freedom only matters if it's used to reassess if the trade's logic still holds, not to sit in trades that have lost their reason to exist. This is really important to understand because at the end of the day, if your logic for getting into a position was purely based on, I don't know, technicals or sentiment, then you need to have a clear idea about when that actual logic is breaking down and if that is valid, because it's very easy to kind of kid yourself and be like, oh, price is doing this or sentiment's doing this, therefore I'm just going to get out. That's more of a reactive process that isn't grounded in actual evidence. But there are ways that can allow it to work. And so I have to rank this in terms of control as high. So next one is costs. So I'm going to put this as low to moderate. Again, the reason there's most fluctuation normally on the cost section is because costs can vary depending on the specific type of swing trading there are. Someone who's trading, with an average holding time of 4 days is going to be different to someone whose average holding time is 3 weeks. And so just keep that in mind. But the long and short of it is that trading less frequently means fewer transaction costs and less execution noise, a genuine improvement over scalping or day trading. But holding positions for weeks can introduce other fees. For example, with FX, you have swap fees, which is to do with the interest rate differential between the two currencies. And it's always worse when you're wrong than when you're right. And opportunity costs and opportunity costs that most retail traders underestimate. Next one is the impact depends on position duration and funding costs, but the key is that these costs are manageable and not invisible. That's the key part to focus on, is that with this, so far, out of all the methods we've gone through, the costs here are the most manageable. They're not invisible. They do still exist. They still have an effect, but they are the most controllable. Finally, we have conviction. So again, moderate. Swing traders often feel more confident because trades last longer, setups look cleaner, but the confidence is still mostly visual, right? It's not causal, meaning it's not based on things that actually cause markets to move. It's confidence based on patterns and visual recognition, it's different as you'll see later on. So without understanding why a move should continue beyond the chart, conviction disappears as soon as the market stalls or retraces. So this element is similar to scalping or day trading. It's just spread over a longer period of time. But the conviction, the reason that it's higher than day trading or scalping is mainly because with day trading and scalping, by definition, there's more noise. And as we kind of mentioned with, I believe, Edge, the conviction is going to be based on something that's actually true, right? If there's less noise, because there's more potential for that confidence to be based on something real than something fake. So summary, I believe, yes. So retail swing trading is the strongest of the traditional methods. It's calmer, it's more selective, and often more sustainable. Obviously, there are exceptions to this. It doesn't just mean that retail swing trading is, the best, and that's all great. But even the best technical systems here rely on cooperation from the market rather than a comprehension of it, which is where the weakness lies. This sentence is so important to understand. This is something a professional will look at and be like, oh, okay, but if I don't have comprehension of what's going on, then that is going to be a weakness. Imagine that you had an investor, again, same example from earlier, let's up it, that gave you $1 billion. Are they more likely to give that to you if you're like, oh, I've got a lot of conviction, trust me, I've seen this pattern loads of times, it works, and I just use a stop loss? Or are you going to trust someone who's taking a really thorough professional approach and understands exactly why they're taking that position beyond what the chart says? Probably you're going to go with the more professional sounding person. That's just the reality. So the next one is retail event trading. So the definition for this video is trading directly before, during, or immediately after major economic or corporate releases, aiming to profit from new information hitting the market. So as always, I've had to generalize this into a general category. There are ways of making this work, but for the most part, beginners will tend to do things like trade the NFP release, trade consumer price index or the CPI, company earnings, and we'll assess this based on how the average retail trader approaches it rather than a professional, because it's a better analogy of what retail traders are actually doing, and it will make sense as we progress through the presentation. So first category is always survivability. This is arguably one of the lowest of all of them, arguably worse than scalping in the way most retail traders do it. Event trading edges vanish the second the release hits, for the most part, because liquidity thins and spreads explode. This is especially true in more liquid markets like FX. There are elements in stock markets like post-earnings drift, which I mentioned earlier, which is the idea that when you have a massive surprise in company earnings and there's a big reaction, let's just say a positive reaction, the stock goes up, there is evidence that general direction tends to drift continually. So if you have a big positive shock, sometimes that positivity will turn into a kind of mini trend for the very, very near term, or sometimes the medium term. However, in general, a lot of the edge that retail traders are trying to capture, which is normally quick in and out, that edge goes basically instantly, right? And so even correct forecasts can reverse instantly. So you can be right about the number, but you can be wrong about the reaction, because you're not just trading a number, you are trading people's interpretation of the number. And if you don't understand the context of how that number fits in with the rest of the economic puzzle, then you're doomed, because you're looking at a number as this is good or this is bad. That's not how the market works. You could have really positive inflation here, really positive, the same amount over here, but the same surprise, everything at two different points in time. And one time the market goes down and the other time the exact same market goes up. How does that make sense? Well, it's all to do with context. And retail event traders are normally trading like an economic calendar, waiting for the NFP release and being like, oh, NFP was worse than expected, therefore that's bad for this country. That is the definition of being dumb money. More on that in a minute. So, in other words, you're not trading analysis, you're trading reaction speed at this time horizon, and algorithms will always win long term on speed. They also have huge advantages, millisecond advantages on you in terms of how quickly they can execute, latency, this sort of stuff. So, as we move to edge, we have to put this as very low again, because in hindsight, the payoff of event trading systems looks great. You look at a news announcement, you're like, oh my God, look at all that volatility that came out. This is probably somewhere where I want to focus my attention. But it disguises timing, it disguises luck, slippage, costs. And so it's not really that repeatable as an edge in how most retail traders use it. And so again, you're competing against algos plugged directly into data feeds. They're plugged into the data sources, so they're getting the information faster and they can act on that information faster than you. And they're computing more than you can compute with 2 hours in seconds or milliseconds. You're not going to beat that. I'm sorry. I'm not going to beat it. You're not going to beat it. It's just not going to happen. And these algorithms will arbitrage the inefficiencies long before retail orders even hit the order book. Next one is control. So I'm going to put this as low. Most retail traders gamble on the data print. We've already kind of discussed this. Professionals just don't do this. They position weeks in advance based on evolving expectations, and they normally have predicted a lot of the things and priced in that prediction way before the number. I'll give you an example. Most retail traders look to NFP as if it's the answer to some sort of big thing in the economy. Most professional traders are predicting what happens in NFP way before it happens. Same with inflation. They're already pricing in that expectation. If there's a surprise, yes, that can cause something significant, but that doesn't mean that there's necessarily an edge there either, because you're still against the algorithms and you're still trying to interpret, is this going to be perceived as good or bad, which changes over time. And if you don't understand the broader context, that's not going to make any sense to you whatsoever. You're just going to see a reaction and go, oh, that's weird. It didn't do what I thought it would do. Yeah, because there's no comprehension behind what you're doing. That is why the edge is low here. It's why the survivability is low. And it's also why the control in this case is low. And so by the time retail traders react, the professionals are already adjusting exposure or using the dumb money of the retail to exit their positions. For example, if you've been trading the idea that you think NFP is going to come in way higher than expected, you could be positioning. And then when it comes out, as all of the dumb money comes in, you could sell it off to them. And then you would be making money and exiting based on all of those retail traders getting it. So costs very high again, because during major news, spreads widen, slippage increases, and that can turn what was initially a small risk into a full stop out, or maybe even more, because prices can gap away from your stop and you can have a stop way bigger than you initially thought. You can try and mitigate this by having kind of, basically, there are ways of playing both sides, which I've done in the past. However, that's not really a traditional retail strategy, so I have to put the costs as very high here. Even with what I was doing, the reason I stopped doing it was just because the costs were unbearable. So the execution costs spike right when you need precision most, turning good ideas into bad fills and random results. Conviction we have as moderate. So retail traders often feel a lot of conviction when trading events because they think that they're using fundamentals. See my quotation marks in the top left here. However, this is not fundamentals. This is gambling, right? And therefore, the conviction here is that sense that we've had with previous strategies we've compared here, which is a false feeling of confidence, not true confidence, a false feeling of confidence, which is, to be honest, even more damaging. So, in summary, retail event trading looks exciting because it can compress a lot of movement into a few minutes or a few hours, but that's exactly why it destroys most accounts. Professionals don't trade the release. They've priced in the outcome weeks or months in advance. Retail traders who try to compete in that window aren't being smart and exploiting an inefficiency. They're usually just stepping directly into one of the most efficient and least forgiving parts of the market. You could say that there are inefficiencies with this particular style that retail traders are trying to exploit. So it's not totally fair to me for me to say that, you know, this is one of the most efficient. What I mean by that in this case is that it's more so the way the market tries to capitalize on that is very systematized now, meaning it's very much a game where all of the players are competing in a very similar way to capture a small edge in that domain. That's significant because it means that from your perspective, whether it is an efficient market or whether it isn't in that particular time window, it's going to have the same effect. It's going to look the same to you. It's not going to work for you for the most part, or most likely. And so That's what I mean when I say the most efficient. It doesn't mean it's actually a perfectly efficient scenario. It just means the way the players are playing it mean that to you, it's going to feel like it's efficient. It's going to feel and be the same outcome as if it were perfectly efficient, because you won't be able to make money with it, or it's massively less likely that you will. Hopefully that makes sense. Let me know in the comments below. So we've gone through the most common 4 strategies now. You've seen where each one has some strengths, where it has weaknesses, and hopefully I've done a good job of explaining kind of some of those reasons. Let me know below. And so the big question, the big reason that you probably clicked on this video to begin with is, what is it that professionals actually do? What are they doing differently? And so SPC is just a coined acronym, right? Which is systematic portfolio construction. What the hell does that mean? So systematic portfolio construction means managing multiple fundamentally backed positions, each built to profit under different and sometimes often complementary market conditions. So I'll give you a clear example of that in just a minute. The goal isn't perfect prediction with this, it's an intelligent balance. Most of the work happens before any trade is placed, not in reaction afterwards. So what does all of that mean? Let me show you with an example. Sorry, I just had to move my face to the bottom left there. So one of many examples of a way that SPC aims to profit from being wrong is, let's just say that if we looked at car batteries, right, and we thought they were going to get cheaper. So that would mean that for an electric vehicle company, then their profit margins would probably go up, which would be positive for the stock. That's great. Obviously, this is a very simplified explanation, but you get the point. But the key thing is, what if you were wrong? What if car battery prices actually went up? Well, a pure technical trader would say, well, it's hit my stop loss now. I move on to the next position. That's it. It's just a loss. It's the nature of the business. All the sorts of things traders will say. But a professional isn't just reacting to this. They've planned for this specific scenario and positioned in a way to potentially profit from being wrong. Let me show you what I mean. So on the bottom, we have the same flow that we had before. We had cheaper car batteries, means the electric vehicle company probably has an increased profit margin. Obviously, there's a lot more steps to make sure that there's nothing else that's going to destroy the company. And then the stock goes up, right? So in brackets, I also have an asymmetric risk reward to absorb the other loss. I'll explain that in a minute. Let's just say you were wrong about that. But you planned ahead, right? So you were like, okay, well, if car batteries don't get cheaper, if they get more expensive, who benefits from that? Well, one example, an obvious one, would be the people that manufacture the electric vehicle batteries. Their profits are likely to go up because as the probably the supply goes down, the demand, meaning the price, goes up, and therefore they will probably make more money on those batteries, depending obviously on a few other things, but as a general example. And therefore the stock goes up. Now, a professional in this particular example, albeit a much, much simplified example compared to reality, because they're positioned in both strategically and they have an asymmetric risk reward, which at a very basic level is just having a really positive risk reward, like, you know, risking 1 to make 4, risking 1 to make 5, etc., that it can actually get more complicated and actually more advantageous than just the traditional way a lot of retail think about it. But the idea is that even if you're wrong about one, the one that's right means that you're still set to profit more from whichever one wins than the other one is going to lose. And so the whole idea is this is a form of hedging. And so obviously, as I've mentioned, this is a massive, massive oversimplification, right? There's obviously a lot more to it than this. There's more nuance, there's more steps, obviously. But it's one of many ways that professionals structure their positions ahead of time instead of reacting to the market to potentially profit from being right or wrong about particular ideas. And this is the exact same process that applies across all markets. So this was the biggest shift in my own trading career, and I wish I could say it happened overnight, but it just didn't. It was an absolute nightmare, right? At first, it was brutal. The information was fragmented, overcomplicated, and often deliberately vague. I find quite a lot that when I'd search all this stuff up, you know, I'd read 3 or 4 books on a particular area, and some of them would all have conflicting information, and some of them would say this was important or that was important. So I ended up with tons of these tools, and I just never knew, like, okay, was it this or was it that? And so I had to comb through like dozens of bad ideas to find a single insight that was worth keeping. And it just took so much trial and error. It was an absolute nightmare. And it's also part of the reason, if you've been following me for a while, that, you know, I stopped making videos because I was so dedicated to, for about a year, by the way, because I was so dedicated to really honing in the craft, really understanding it, that I just didn't have the mental capacity to make videos anymore. And even the year before that, I was slowing down on content and various things. And it's because it's so difficult. It's so difficult to find good information out there because it's scattered with all of the kind of broker incentivized media out there, which obviously causes so many false beliefs and narratives and various things that we've spent this presentation talking about. And so, after years of refining, I distilled everything into a repeatable framework now, thank God, that predicts and adapts systematically instead of reacting emotionally. But I know this sounds like I'm really biased, right? But to keep this fair, let's actually see how this professional approach ranks against the same 5 categories that we put all of the other strategies against. So, survivability. So, SPC is designed to adapt. It's a fundamentally driven portfolio built to be predictive of markets, not just reactive, which means that we're not waiting for something crazy to happen before we're like, oh God, this is bad. And because things are fundamentally driven, because, for example, with the electric vehicle battery example, because you know the reason why you're in one position, that means that you can manage risk in a more creative way than a technical trader could do, which is just, I use a stop loss. Like that's the only real option you have as a technical trader. You can use other kind of complex tools, but really it just comes down to something that you can do in terms of getting in and out. But if you know why you are getting in one position, it means that you can think about scenarios, real world scenarios of, okay, well, if I'm wrong about that, then I could potentially position myself here. And as long as both of these are asymmetric, meaning I make way more when I'm right than when I'm wrong, then I can potentially profit from that scenario. And so that's actually just a more sophisticated version of risk management, if you think about it, and gives you more options and gives you more ability to plan and move things around. And obviously the example I gave was with, basically 2 stocks, an electric vehicle company and a manufacturing company. However, the same process applies to FX, it applies to commodities. They all just have slightly different market frameworks and what those markets are built up of and the factors that drive them. But the most important thing that you need to keep in mind is that survivability is high with this because it has reasons why you're getting in, and it also has the ability to come up with structured game plans about how you're going to deal with real world events. You can't do that with a technical system. All you can say is that, oh, if it hits this price or this time, I'm going to get out. Different and less sophisticated. So again, processes are designed to assess, predict, and manage changing environments, identifying where risk and opportunity are shifting before the market does. Edge. Very high again. So the edge comes from cause and effect, not coincidence and pattern recognition. This is really important. Capital is positioned where liquidity, volatility, and macro drivers all align, which creates asymmetrical opportunities by design. That is just a fancy way of saying when you've got the things that actually move price behind you, prices are more likely to move, at least when they do, they're likely to move a significant distance that ideally we can profit from. So instead of one setup working occasionally, it's a repeatable framework that consistently finds where the best reward is, as well as the best structure to capture it, right? So the next category is control, as always, and I've rated this as moderate. So whilst the decisions are planned and deliberate, which gives you a lot of time and control because you're not tied to a particular chart or whatever, it does require ongoing work, research, and understanding of how some of these markets actually function, which is a little bit different than, open up your charts, draw some lines on it for 15 minutes a day and move on. Like that just isn't the case. And so it's only fair that this is ranked as moderate, not, high control. You could argue that it's high control, but for different reasons. Like you've got more control of the structure and the reasons, but in terms of the way we've reviewed the other ones, it's slightly lower than I believe retail swing trading, which we ranked as high. But unlike technical only systems, the effort that you put in compounds. So with every cycle of analysis, the sharper the framework actually becomes. This is important because a lot of retail traders, myself included back in the day, I would spend so much time studying the charts, analyzing them, backtesting them. And it took me a long time to realize that effort wasn't compounding. If it was, I would have suddenly had a huge breakthrough that was like a crazy defining moment. But that didn't happen. If anything, I came to the conclusion that everything was a different version of the same thing with technicals. Like whether someone uses a trend line or they use moving averages or they use an order block in a trend or they use some other tool, like they're all just different ways to capitalize on a trend. And there's only so many versions of the same thing you can learn over and over and over again before you realize, oh, wait a second, like this is just the same thing repackaged to make it sound better. And so The difference with this is that when you actually do put the effort in, you're going to see real world patterns and real chains of cause and effect that actually mean something. Like the car battery example is the one we've gone with for this presentation, but really it extends to anything. Like there's real cause and effect relationships that are going on in the world every single day, and really the only difference between being in front of it and being not in front of it is just education. So next one is costs, of course. Costs we're going to put as low. So when done correctly, keyword correctly, costs are factored in from the start. It doesn't mean they disappear, but that's why investors trust professional managers, not because they trade differently, but because they control risk through clear, multi-layered processes. Multi-layered is the key phrase there, because as I've mentioned a few times so far, retail traders will normally be like, I manage risk because I use a stop loss and I risk 1%, 2% per trade or something like that. Professionals will have a multi-layered process to look at their risk, as we've already gone through one example of using a hedge based on two fundamentally complementary ideas, but there are many other ways of doing this as well. So it's a world apart from retail thinking. I use a stop loss with a 2-to-1 risk reward, so I manage risk well. One has depth, the other is superficial. So next one is conviction. So conviction with this is arguably psychologically at least, it's probably the biggest benefit, because conviction comes from clarity and every position has a defined narrative backed by measurable data. So you're no longer guessing whether a pattern holds, you know what you're exposed to and why. It doesn't mean that every guess and every idea you have is going to work out. Of course not. But the idea is that when you do make a decision, you can always look back and be like, oh, I know why I took this. I know the factors that led me to actually take this. I'm going to judge whether I should still be in based on a systematic way of looking at, has that reason that I got involved in, has that changed? And there's a whole process to go through to actually understand that. But the fact is that with this method, there is the option of that. And so that clarity lets professionals hold through volatility and even design risk structures that can turn adverse scenarios into profit, like the electric vehicle battery example that we gave. But another key part that I've said there is that clarity lets professionals hold through volatility. How often do retail traders, maybe yourself, I know I've struggled with this in the past, struggle to hold trades to target, especially if you've got bigger risk rewards? It's difficult. And it's really difficult when all you've got to justify why you're in that position is a line that you draw on the chart. And then you look back while you're in the position and you realize, oh, I didn't draw that line correctly. Oh, I could have drawn it this way. And you start telling yourself all these stories. It's so easy to disagree with the reason why you get into why you got into the trade technically, because you can technically make any argument you want with technical analysis. Like, just because I get involved, if I really zoom out enough or draw my line or zone in a different way, I'm always going to be at a new level or breaking a different kind of structure. And so I can always find arguments for whether I should be long or whether I should be short. And so it's very, very difficult psychologically to trade that way because you've got no conviction whatsoever, which means that all of the trading mistakes that every trading book correctly brings up, which is good traders tend to hold their winners for a longer amount of time. They cut their losers short. All of these classic bits of advice that sound really meta and everyone always talks about them, so everyone just assumes they know them. But professionals are building their system in a way where the actual system itself is making that form of trading a lot easier. That's the main idea behind what they're doing and why. So hopefully that makes sense. So, in summary, systematic portfolio construction isn't about predicting every tick. It's about building a structure that profits from how the markets actually move in a balanced way. You're not over leveraging in one very tiny specific asset. It's about spreading the risk intelligently and then basically building it up from there, improving risk adjusted returns, which basically just means the amount of return you get per unit of risk. So it's not perfect, but it is robust, it's logical, and it's grounded in real world cause and effect, which is why professionals choose it and why it consistently outlasts the other strategies that we have discussed. So if we compare all of these side by side, it becomes pretty clear why professionals pick SPC. You know, survivability is very high and very high. That none of the other methods get anywhere near to that. And then obviously moderate control, so it's beaten by retail swing trading, but with costs we can see low and conviction very high. We don't even get too high with any of the other methods on conviction, because the reason you're getting involved is based off a drawing. You know, that's the bottom line. So the criteria that we've gone through shows exactly why professional traders adopt an approach like SPC. Maybe they call it something different, but That's the general thing that a lot of professionals are using. And the idea here is that they're not chasing setups. They are building structures where survivability, edge, costs, conviction are all working in their favor or edging more towards their favor rather than against them. They don't want to fight in battles where the odds are against them. Yes, you could be a scalper, but do you really want to be the 0.1% exception to the rule and be that person and all the pain that comes with that? Or do you want to stack the odds in your favor? Like, to me, it's a no-brainer, but obviously everyone's different. And by the way, none of this is financial advice, obviously. So the real challenge isn't knowing that this works, it's knowing how to actually build it for yourself. So when I finally understood this, everything began to click for me. But getting there took years of learning, trial and error, testing things with like hundreds of variables, and then breaking it down into kind of what it is now, which is just a simple step-by-step framework. And so I've broken it down into this systematic, simple framework that leverages the right information as well as the best technologies available today to make the job a lot easier. Like before, I'd have to go and research all of this stuff and it would be an absolute nightmare. Now I can leverage AI for a lot of those processes as well, and it makes my life a lot easier. And so if you want to see how this process works in practice, I built a free Telegram, which I'll leave in the description box below. And I'll share weekly insights, market breakdowns, hosting Q&As as well, like ask me anything, that sort of stuff. And you can just ask me whatever you want in there, and it's going to be probably the simplest way to see what a professional process actually looks like. And I'll give you as much detail in there as I can, insights, all that sort of stuff that you might be interested in. So please do join me there. I would really appreciate it. But look, if you want to learn the A to Z process, you want to professionalize your trading approach, then you're more than welcome to join my one-on-one coaching program, which is called Professional Insider, using the link below. You just have to answer a few short questions in the application, and I'll review each one just to make sure that you're at the right stage for me to genuinely help. Not everybody is. This is a very specific type of program and understanding, and it's not really going to be suited to beginners, for example. It's just not. But whichever stage that you're at, the important thing is to remember the key takeaways from this presentation, right? So this has not been a video of me showing you which strategies work versus don't work, right? This has been about showing how professionals pick the battles where they have the biggest advantage. It's also why many retail traders and retail strategies struggle to fully overcome many of the things that makes the strategy robust. It is possible, but it's challenging. And finally, professionals want to survive. They want to have a strong edge. They want to pay little in cost, be ideally in profit if the market goes up or down, and have conviction whilst doing it. That is the key, and that is the most important thing. So guys, if you got this far, I really, really appreciate it. I'm assuming most people didn't, so fair play to you. I have left below this video also the link to various sources for statements that I make in this video. So I try as best I can, and will try from now on, to always try and back up the statements that I make with things that have been proven through empirical or academic research. Now, it's important to note that just because it's in like empirical research or academic research doesn't mean that it's like perfect, proven, no argument forever. It's not the case, but the way I look at it is it's a lot more thorough and it's a lot more reliable than an opinion that someone's developed because they've been trading for a year compared to someone's actually gone through it and rigorously analyzed it. So that's why I've included those sources. I may have missed one or two things. If I have, please let me know. I'm more than happy to go into more detail on that. And as always, guys, you know, one of the things with making these videos is I don't know what level of experience you're at. And, you know, 10 viewers could have 10 different levels of knowledge and experience, which makes it tricky sometimes to communicate ideas effectively, because sometimes I go too broad and too general, trying to appeal to more people, or sometimes I go too specific and too technical. So I'll be interested in what sort of content you are most interested in seeing. Best place to do that is YouTube comments, or obviously in the free Telegram, which by the time you're watching this will be more up and running and have more content in it. If you're interested in kind of going through this process weekly with me, understanding what I'm doing, professionalizing your process, and you're not a beginner, then one-on-one coaching would probably suit you. Just FYI, if you are a beginner, for your own time's sake, I wouldn't bother applying to the coaching. It's just not built for you. But there's plenty of resources that I'll be sharing completely for free on the Telegram, and on YouTube here as well. So I'm going to stop yapping now. My jaw kind of hurts from all the talking. But guys, I really appreciate it. And thanks so much for the support, whether you're new here, whether you're a long-term supporter of the channel. I appreciate each and every single one of you. And if you've got any questions, as always, just reach out. I'm always available, always open. So take care, and I'll see you soon.